Welcome back to the Valuable Investor channel. I'm Logan, your favorite former gold broker, and today we're diving into the topic of the United States debt ceiling, a complex and often controversial financial mechanism that has significant implications for the U.S. economy and the global financial markets. Join us as we break down what the debt ceiling is, its history, and the potential consequences of not raising it. What is the debt ceiling? The U.S. debt ceiling is a legal limit on the amount of money the federal government can borrow to finance its existing obligations. It's important to note that the debt ceiling doesn't control or limit the government's ability to spend, but rather its ability to borrow money to pay for spending that has already been approved by Congress. In other words, the debt ceiling is like a credit limit on the government's metaphorical credit card. A brief history of the debt ceiling. The debt ceiling was first introduced in 1917 during World War I as a way to give the U.S. Treasury more flexibility in managing the country's debt. Since then, the debt ceiling has been raised or suspended numerous times, often accompanied by political debates and negotiations. In recent years, the debt ceiling has become a contentious issue, with lawmakers using it as a bargaining chip in broader budget negotiations. If the U.S. government reaches its debt ceiling and is unable to borrow more money, it faces the risk of defaulting on its obligations. This could include failing to make interest payments on Treasury bonds, not paying Social Security benefits, or even missing payroll for federal employees. A default by the U.S. government would have severe consequences for the domestic economy and could trigger a global financial crisis, as U.S. Treasury bonds are considered one of the safest investments in the world. The politics of the debt ceiling. The debt ceiling has become a political hot potato in recent years, with both major parties using it as leverage in budget negotiations. This has led to a series of high-stakes standoffs, with the threat of a government shutdown or default looming large. Critics argue that the debt ceiling is an outdated and dangerous mechanism that creates unnecessary uncertainty and puts the global economy at risk. They propose alternatives such as eliminating the debt ceiling altogether or automatically raising it in line with approved spending. The future of the debt ceiling. Given the potential consequences of not raising the debt ceiling, it's likely that Congress will continue to find ways to avoid a default. However, the political wrangling surrounding the debt ceiling is unlikely to disappear anytime soon. As the U.S. national debt continues to grow, the debate over the debt ceiling and the broader issue of fiscal responsibility will remain a critical topic in American politics. We hope this video has provided you with a better understanding of the U.S. debt ceiling and its implications for the economy and global financial markets. If you found this information valuable, share it with your friends, and subscribe to our channel for more insightful content. We'd love to hear your thoughts on the debt ceiling debate, so leave a comment below. Stay tuned for our next video, and until then, happy learning, happy earning.